Hello, everyone. I'm Yesenia Reynoso, Director of Strategic Communications and Growth at Genius Visionary Inc. and Genius Tax Advisory. Welcome to Tax Talk 25, Strategies, Check, and Smarter Planning for the Road Ahead. We are all so incredibly excited to be here with you for such an outstanding and high power jam-packed conversation surrounding everything revolving taxation, whether it's tax changes, wealth management, IRS audits, and so much more. So welcome and happy Thursday. So as we um as we commence into our conversation, I just want to do a couple of quick housekeeping notes here. Before we initiate our conversations, Genius Tax Advisory, if you are all interested in learning more about our services, from tax preparation, tax planning, to wealth management, real estate planning, and everything in between, please visit us at www.geniustaxadvisory.com. We are also live on LinkedIn. And in addition, we also just recently launched our blog where we're going to have a ton of informative pieces surrounding the taxation industry. And coming soon will be our initial newsletter. So keep an eye on that. And so, before and finally, one of the things that we are going to be offering here is a free discovery call. And so, if anybody here is interested in learning more about our services, in addition, if there's any other questions that you may have surrounding any of these key topics, you could certainly discuss with one of our fine Genius Tax Advisory experts. And so now I will hand the floor over to our outstanding panel of experts, each of them bringing very specific topics and areas surrounding the taxation industry. And so what I'm going to do and ask our fellow panelists is that to please give your name, first and last, your title, the name of your organization, and what you do what you do on a day-to-day basis. And so I am going to go based out of who I see on my screen to the right. And so Abby, you are the first window that I see here, so feel free to take the floor and introduce yourself.
Thank you, Senior. Thank you, everyone, for joining this discussion today. And my name is Avi Prakash. I'm a certified financial fiduciary. So I basically help my clients based on their financial goals and tax-free goals. I'm a tax-free wealth advisor. So I make sure that most of my clients have some kind of tax-free wealth strategies in their portfolio, and also do a lot of Roth conversions and RMD conversions as well, where we leverage an A-plus rated insurance company to pay majority of your taxes so that it is not coming out from your pocket. So I'll be happy to discuss about any kind of tax-free wealth or any kind of, offsetting your taxes through Roth conversions, which is a very powerful strategy as well. That's about myself. My company is called growwithabi.com. And I have an office in Rockville, Maryland, if anybody wants to stop by the office as well. And obviously, you can reach out to me directly to know more about these tax-free wealth strategies. Thank you so much, Yasina, and I'm looking forward for this.
Thank you, Abby. Really appreciate it. And now the next person who will get the digital mic is John McFarland. John, take it away.
Thank you, Sheila. Hi, everybody. As she said, my name is John McFarland. I'm a national sales executive with a company called Cost Segregation Services, Inc. You'll see it many times just as CSSI. And we're located in Baton Rouge, Louisiana for the corporate office, and remotely around the country, we have individuals such as myself. So my day to day, we're working with owners of commercial real estate, owners of investment real estate, CPAs for their clients, financial advisors for their clients, any direct access to tax savings through cost segregation. briefly, cost segregation is just that. We segregate out personal property from real estate. So everything I do goes around real estate ownership, or participation as in a leasehold. Um, our company's been around since 2001, and we've done over 50,000 studies for Internal Revenue Service. We've saved our clients over $55 billion in that amount of time, and we've never had a finding by Internal Revenue. Cost segregation is a regulated tax process with Internal Revenue, and it's being done by a number of companies, but we are number one in the nation and have enjoyed our position. I love working with this company. It allows us a lot of opportunities, and I have personal clients across the country, so we're not held by geographical boundaries to any good extent. And I'd be happy to get into detail on what exactly cost segregation does as we go around through this circle. Thank you.
Thank you, John. And so next up on my screen is Guy Cohn. Guy, take it away.
Hi everyone. So my name is Guy Cohn. I'm CEO of a company called InsurTax. By the name, you can understand what we do. We do IRS audit insurance for small businesses and business owners. Basically, we're trying to fill a gap that exists in the market where large corporations have access to this financial tool to protect them when they have specific positions, tax position that they take, and that can be challenged. For smaller businesses, even if you file a flawless return, sometimes you get audited as a routine audit, and then you need to represent basically your business in front of the IRS, and if you are already low on resources, doing it on your own, it's a big mistake. So we're trying to provide this flexibility and peace of mind, having the resources to deal with an IRS audit, which can be a very stressful event in the life of a business. So that's it. That's what we do. Thank you.
Thank you, Guy. All right, we now move on to our next speaker, which is Krishna Mohan. Krishna.
Hello, everyone. My name is Krishna Mohan. I'm the President and CEO of Genius Tax Advisory. My role is to bring strategic growth for the business and put together a team of experts that would bring best possible solution for our clients. We address the issue of tax from three different angles. One is asset and liability protection, tax liability mitigation, and wealth preservation and growth. This is our motto. With that being said, we have several partners bring different solutions to the table. Today, we are able to bring in 4 experts to this informative call. I wish and hope everybody gets a tremendous amount of value, and we are planning to continue this series on and on. I wish everybody a good time, and hope get tremendous amount of value from this call. Thank you.
Thank you, Krishna. And finally, our last panelist is Shai Rao. Shai?
Hi, my name is Sham Rao. Short, she calls me Shy. So I'm a senior tax advisor for Genius Tax Advisory. Basically, I help business owners and others on how to decrease their taxable income or increase their tax refunds. In effect, as an advisor, I ensure the clients don't pay more in taxes than they need to based on their income level, investments, and other factors by conducting audits of their tax returns and resolving tax issues with the Internal Revenue Service or the state tax authority. So basically, I perform the following tasks. I do research tax issues and ensure the clients are tax compliant. I prepare and review tax returns, corporate and personal income tax returns, sales and use tax, property tax, franchise tax, and estimated taxes. I advise and consult on taxation issues. I represent clients before the Internal Revenue Service. because I'm a certified public accountant and I review proposed legislations that would affect clients' taxes. So in short, that's pretty much what I do. So if you guys need any help in the future on any of these topics, please feel free to reach out to Krishna and Genius Tax Advisory. I'm looking forward to helping you all.
Thank you, Sham. Really appreciate it. Thank you, fellow panelists. And now we are going to dive in to our actual panel discussion. Again, as I reiterated earlier in the virtual show, we are going to be navigating through 6 categories. Each category is going to be about 7 to 8 minutes, and all the panelists will have an opportunity to offer their expertise under each topic. All right, so we will now initiate with our first category, which is top tax changes for 2025. And so, fellow panelists, the first question that I have is, what are the most impactful changes in tax legislation for 2025 that individuals and businesses need to be aware of? And we will kick it off with Abhi.
Thank you, Sina. So the top tax strategies for 2025 is if you do a smart planning now, you have to pay less taxes later. So as a financial planner, I help clients reduce their taxes, grow wealth, and protect their legacy. And some of the top tax strategies that you should be aware of for 2025 is Roth conversion. So Roth conversions in a low tax year with a potential tax increase on the horizon on January 2026 could be an ideal way to convert your traditional IRA dollars into a Roth IRA, and especially if your income is temporarily low due to retirement, business loss, or other income day. So you pay taxes now at a lower rate and enjoy the tax-free growth with withdrawals later. And then you also pretty much do, use qualified, insurances and annuities to basically make sure that you have tax deferred growth using a cash value life insurance for tax-free loans and estate planning as well, which is also called the Richmond's Roth. So we use tax deferred strategies and guaranteed income for life strategies in an environment where there is so much of market volatility. At the same time, for businesses, we optimize business deductions and business loans where you do not have to actually leverage from a bank, where we can use an A+ rated insurance companies to leverage them to pay off any loans that you have. And you utilize the tax exemptions and the estate planning exceptions as well, which is basically coming up on January 1st, 2026, where the government has changes to their tax laws on estate planning. So I could help you out with some of the tax-free strategies, and you can discover more about it based on your financial goals. That's just to start off with. Thank you, Asina.
Thank you, Abhi. And so before we transition to the next question, does anybody else from our panel would like to chime in on that?
I'd throw something in a little bit real quickly.
Sure.
One of the things that's overlooked, again, this leans towards real estate. The low-income housing tax credit, called LIHTC. The credit incentivizes the development of affordable rental housing by providing tax credits to developers and offering a dollar-to-dollar reduction in federal tax liability over a 10-year period. Today in America, we have a shortage of housing, and it's not going to get any better. This is one of those tax incentives that developers who've maybe not entered into the affordable housing market before, this is a year for them to be able to do so and help shrink that housing crisis and make it affordable.
Great, thank you. So this question is, how can high income earners prepare any policy shifts coming in the next fiscal year?
Yeah, so there are many out there. I mean, I have a couple of strategies that we can utilize for high income earners that I just want to talk about a little bit. There's a strategy called equipment leasing, where these are for individuals who earn 300K and above, $300,000 and above. They would basically form their own rental company, an LLC, purchase and rent out equipment, and receive monthly rental income. and be eligible to write off all the cost of all of the equipment against active income or W-2 income. So basically, for example, if you had $500,000 in annual income in W-2 earnings or business income, you can pretty much write off all of it with one shot by purchasing $500,000 in equipment without much cash out of your pocket, where you would leverage, meaning you would borrow and invest about $10,000 and you get, I'm sorry, in the example of 500,000, you would invest for $50,000, and that $50,000 will earn you a return, and the remaining $450,000 will be serviced. The debt will be serviced by the leasing income that you would receive from a specific company that I won't name right now. That is one big strategy that people can utilize. These are strategies that are used by people who are wealthy and don't have and have the wherewithal. They work with tax advisors like us to help them mitigate taxes, or in this case, maybe even be able to reduce their taxes by 50 to 70%. And there's also another strategy called oil and gas deduction. People may be familiar with it. I'm not sure. Well, for example, if one were to invest $250,000 into this oil and gas strategy, you'd be able to reduce your income by 87% of that $250,000. We actually did that this past tax season for several consumers, several taxpayers. So those are two high-level income tax strategies that one can utilize to reduce their taxable income. And there are others as well, but I just thought I'd mention those two because those are easy to execute.
Great, thank you. So does anybody else want to quickly chime in? Or if not, we're going to move to our next category, which will be maximizing deductions and credits.
Can I jump in? Can I jump in on that real quick?
Sure.
The one thing, high income earners often look at investments and how those investments might help them offset income. And generally, in a lot of cases, they're limited as to what income they can offset earned income. Say it's a doctor. There's a process within IRS called grouping. And if you're a doctor and you're maybe a partnership doctor, a couple together, 3 or 4, whatever, and you're looking to offset your personal income from your practice, it's hard to do with investments. If you buy real estate for your office, you can basically only offset the passive income that other renters from your office building pay you. Unless at the time of purchase you do what's called grouping. When you group, you're grouping the two businesses together. You have a real estate business and you have a dental business or a medical office business. This is going where you've got other renters again in the building. By grouping, which you normally have to declare in the first year that you buy the building, you're then allowed to offset your personal income. There's measures that have to be met, and I'd be glad to go over them some other time with anybody that wants to know about them. They're rather lengthy, but it allows you now to offset your personal income that you're earning from your practice. And this can be huge, a huge offset of taxable income for you as a professional and a high income earner. So if anybody's in that arena, or again, if your tax advisor is aware of these and may advise you, it's an opportunity to offset that high income that you are earning, all the while you're building a business with the real estate and the medical practice.
Makes sense.
Thank you. Thank you, John. And now we're going to move on to our next topic, which is maximizing deductions and credits. And so, John, you are going to kick us off with this question. What are the most underutilized deductions or credits that individuals or businesses often overlook?
Well, segregation's one. There's a number of them, and a number of those are strictly tax wise that I don't get into as a real estate professional. Retirement savings accounts, state sales tax deductions, health savings accounts that you might have. A lot of these are overlooked. Educator expenses, job hunting costs, and we're going to have a lot of people, it sounds like, out looking for jobs. That should be a big one coming up. On my side of the industry, people overlook the fact that if you own real estate, you own the building that your coffee shop is in or your tax agency's in, and you've done improvements to that property, repairs to that property. There's a Section 179 deductions that allow you to accelerate depreciation to deduct the full cost of qualifying business equipment, including software, in the year you purchase it. Others missed by small businesses, they think they have to spread deductions over time. There's R&D tax credits that are available. It is a little more complicated, and you definitely want to talk with your tax professionals on R&D because it's a touchy area with IRS. Home office deduction, I think most people know about that, but you really want to look into it. There's a simplified option where you can use a standard $5 per square foot up to 300 square foot for your office deduction and not have to separate out utility bills and everything else. Qualified business income, start out cost deductions, meals. The startup cost is an interesting deduction, $5,000 deduction on your first year of business for costs like legal fees, marketing. So that covers a lot of people, and they will overlook that. And then when it comes to depreciation, so in depreciation deduction, you buy a commercial real estate building, it depreciates straight line over 39 years. If you bought a multifamily, fourplex or something, a residential rental, it depreciates over 27 and a half years. Under cost segregation and a few other lines, we can accelerate that depreciation, separate out personal property. Carpet doesn't last 39 years. Lighting doesn't last 39 years. We can separate out those things that are called personal property, and outside the building, landscaping, all that type of design work outside is also accelerated. So we're depreciating 30%, 35% maybe of your building in 5 years, 15 years, instead of 27 and a half or 39 years. So this is a heck of a windfall, or if you want to look at it more precisely, a huge jump in cash flow for the first 5 years, 5 to 10% cash flow increase in the first 5 to 10 years. So, those are some of the things that you want to deal with your tax advisor. I've always recommended at any time there's three things basically you want to do when you enter into commercial real estate or rental income. It's hire a real estate CPA, it's hire a real estate attorney, and a real estate broker, commercial broker. Those three things will help you a lot. You don't want to cut yourself short by not investing in knowledge that these people hold for you to capture all the tax incentives that are out there for you. Is that good?
Yep.
Very informative answer, John. Thank you so much. Now, does anybody else in the panel would like to add on to that, or we can move on to the next question?
Yeah, I would like to move on. I would like to actually answer one of the question about the planning opportunities before 2026. So the estate tax exemption is actually coming into the Congress, where we are reducing it to like 7 million, and it's going to impact around expose millions of more in assets to 40% of federal estate taxes. So since the debt is at 37 trillion and we have a debt ceiling in August, so taxes are leaning towards going up. So this is your best opportunity to have some kind of tax-free wealth in your portfolio, and also have these tax exemptions in 2025 where you can use it or lose it. So you can make your tax advantages historically with high exemptions, and the IRS has confirmed that it won't claw back these under high exemptions per the IRS notice. So that is something that I wanted to mention it to everybody on the call today.
Thank you, Abhi. That's a great tidbit. And does anybody else have anything to offer before we transition to the next question?
Good.
Good. All right. So now we're going to move on to the next question. Are there any specific industry-specific tax incentives that are worth noting in 2025?
From my standpoint, with real estate, under the Tax Job Act of 2017 that was passed, there was the allowance that I just alluded to before of depreciation, accelerating depreciation. There was also a bonus opportunity within that, which allowed you to take 100% of your 5-year and 15-year property deduction in the first year. That was a huge windfall. But also written into the law was a planned reduction of the bonus. That the reduction was started at 100%, then it dropped to 80%, now 60%. It's dropping in 2026 into 40% bonus. But the thing that may happen in 2025, or the bill may be enacted and they may not actually implement to 2026, is the fact that we want to see this go back to 100% bonus depreciation. This is a huge opportunity for investors down the road in rental, in commercial real estate, strip malls, any manufacturing, any type of commercial real estate buildings that you have has this opportunity. So we're waiting on Congress. It's been in committee. It's looking good, but it hasn't come up for a vote yet. And knowing Congress, they may not get to it this year, or they may let it die. And we just don't know at this time, but we're staying on top of it. And a lot of notices will go out, especially in the tax industry. Most CPAs and advisors are going to know about it as soon as it happens. So anybody in the audience that's looking for this, stay in touch with your people. And if you want to look at what it might look like, you can get a hold of me, and I will be glad to run free analysis on anything that you own to take a look at it. So that's one thing that may happen in 2025, and we've got our fingers crossed on that one.
Gotcha.
Thank you, John. And that is a great segue to our next topic, which is tax strategies for business owners from startups all the way up to enterprises. And one of the questions that I have for you, it's going to be a round robin style. So what tax planning tips do you recommend for early stage startups versus established enterprises? And I'm very curious to hand the mic off to Guy, because I know tax insurance is one of the big assets that any individual should have, and I think that is one of the many planning tips that audiences can be aware of. So, Guy, I will hand off the mic to you so you could elaborate further.
Yeah, thank you. So, as we see it, people have some misconception about audit risk, and if you look at the industry and if you look at the average, it might seem that 1 out of 100 might get audited on every single year. But actually, if you look closer into your industry, if you look closer at what structure of your business, of your tax strategies, for example, if you do claim some credits that are scrutinized by the IRS, etc., then your chance of audit actually increases. And it might not increase much, and from 1% you would go to 2 or 3%. But if you look at the 5 years window, then this 3 or 4% is pretty much very substantial, because it's the chance that you're not getting audited is 97 or 96%, and you start, it goes down exponentially. What are the chances that you will not get audited in the next 5 years? So people should look at a 5 years window, and then if you do that, you would see that in a 5 years window, 1 out of 7, 1 out of 8 people or businesses will get audited. We see it on a broader spectrum than just our own. So basically, we are trying to provide this safety net of when the audit does come, you have the resources. So this is something that we advise, even if you have a very good tax strategy of attorney, a CPA, and they file a flawless return and a very good study, you can still be looked at. And then you should have the resources to hire and the flexibility to hire the best people to help you, represent yourself successfully during an audit.
It's kind of, I find, I think that's quite intriguing, Guy, because obviously the next topic is about audits and compliance, and obviously we could give our audience a sneak peek. But you mentioned something as to how people can prepare for an audit. Do you happen to have any other additional insight as to the kinds of tips or strategies that individuals or businesses can do if they ever received a notice?
First, what really helps, I think, above everything else, is keep documentation, be organized. I think using maybe digital software and making sure that once they do come, then you have everything prepared. I think this is one of the, starting to chase over the documents that you need to show and the reps. This is very hard. So I think just keeping track of, making sure that everything is documented, you have everything to show for. It's very important. I suggest also buying a tax insurance from day one. It's an IRS audit insurance, and the way it works is that it provides you with an immediate payout. So once you get the notice, you don't even need to show damage. The insurance provides you with basically with cash to handle the initial costs. So if you need now to hire professional to help you represent your business, you can do it immediately, and sometimes it ends there. And if stuff gets complicated and escalates, then you can also enjoy the broader defense and invoice. Get services and submit the invoices, and the insurance covers all of your needs to successfully represent yourself in an audit.
Thank you, Guy. That is quite an insightful answer. And one that I think every individual or business needs to be aware of when they're formulating their tax strategy. Does anybody else from the group would like to follow up on that, or we can transition on to our next question? Okay, so we're going to move on to our next.
Hang on, just a couple of other quick notes on the startup costs that you were talking about earlier. So there are a couple of things that are out there right now that it's proposed. The keyword is proposed. The Tax Relief of New Business Act proposes increasing the startup expense reduction from $5,000 to $50,000. So this would allow entrepreneurs to write off more of their initial costs, such as legal fees, market research, and advertising in the first year, and the deduction would phase out between $50,000 and $150,000. And one other thing that John may know about is the Section 179 and bonus depreciation. This allows business to immediately deduct the cost of qualifying equipment and property up to $1.25 million in 2025, with a phase-out threshold of $3.13 million in total equipment purchases. And there is 100% bonus depreciation for new property placed in service through the end of 2026. I just wanted to share that as part of that startup thing.
Yeah, Shai's right. There's others also in there, and I think the small business energy efficient equipment under Section 179D can be a big reduction in taxable income. And electric vehicle tax credit, I don't know if that's going to stay in place with the new administration or not. But electric vehicles can provide federal tax credits with additional state rebates. But we'll have to see where that goes here with the current administration. They cut back on wind power and taken away licensing contracts that have already been vetted out. So that type of energy is being put aside for coal. And those are some of the effects on the taxes coming up.
Great. All of this is incredibly wonderful, and I think something that we all need to be aware of, especially as we navigate through this year. There's definitely plenty of policy changes that are occurring, especially with this administration, and so it's definitely important for everyone to keep a pulse as to where the industry is heading and the different types of regulations that could be changing at a moment's notice. So we are going to move on to our next category, which is supposed to be maneuvering IRS audits and compliance. But since we've had a great conversation surrounding it, what I'm going to do is that I'm going to fuse both IRS audits and tax strategies together so we can continue with this conversation before we move ahead to our next category. And so my next question, and this can very well be a round robin style question, is how can business owners better structure their expenses to reduce their tax burden? So I will open up the floor to anybody who wants to kick us off.
Well, one thing businesses can do that they also often miss out on, especially if they've been in operation for a few years and have been doing some improvements and upgrades and other factors, is that there's a process called CapEx reversal. It's taken items that were capitalized for deduction and changing them into expense line items. So that requires expense line items and capitalization all follow certain guidelines under IRS rules. And you mentioned auditing. It's one thing that gets looked at. So when expense line items or capitalized items are incorrectly categorized, it can cause issues. The advantage is that by having a deep dive into your depreciation schedule over the last 5, 10 years or whatever it's been, 3 years, and reversing what has been capitalized, which should be expensed. Expense items are taken in the year they happen, 100%. So you're taking something that's been capitalized, which is 39 years depreciation, and you're turning it into an immediate 100% depreciation. That's a windfall tax opportunity savings there that businesses can look at. Their financial advisor, CPA, my firm, we do CapEx reversals all the time, can look at those things and help you determine. So any one of the tax professionals here could probably guide you on that, but it's definitely a missed item for businesses that even if you're a small business, it could be a definitely missed item that they need to look at.
I also want to piggyback on something that John said. A few of the other items that, from my experience in the last 25, 30 years, but the IRS, continues. One of the questions that you had, Yesenia, was what triggers an IRS audit in 2025? Some of the factors that I think is like high income levels, taxpayers earning $500,000 or more annually are more likely to be audited due to the complexity and potential for significant tax discrepancies, especially if your income jumps all of a sudden from 200 to 500, all of a sudden you're doing well or something like that. Or unreported, underreported or unreported income, failing to report all income, including like freelance earnings or investment income. Cryptocurrency transactions are something that the IRS is really going after right now. That can raise some red flags. And then, obviously, the obvious ones are the W-2s and the 1099s, which are reported to the Internal Revenue Service. If you don't report them, obviously, that's an easy catch for them. You got to be careful of that. And excessive and unusual deductions, which John talked about earlier, claiming large deductions that are disproportionate to your income. It could be like charitable donations or, business expenses that can attract IRS scrutiny. So those are a few of the things that are very simplistic, but at the same time, those are the ones that they catch.
Yeah.
It's easy for them, right?
Yeah.
The harder ones, they don't want to spend money on a $500,000 income earner to come out and audit and things like that. But These are the easy things. And home office and vehicle deductions as well. You got to be careful about keeping track of your mileage and things like that. So.
That's that's a great answer, Shai. And I think these types of red flags that can trigger potential IRS audit, I think it adds an extra layer of importance where businesses need to get some software or documentation system that they can organize. And so I will pass the mic over to Guy. What role does compliance software or documentation play in audit readiness?
Well, from our aspect, it really affects our loss ratio. So if we look at from the taxpayer, our loss ratio is actually the taxpayer liability. So we see from our side that taxpayers that are using software, then our loss ratio is much lower. It makes the whole process easier and streamlined. So imagine we just need to flip the mirror, and look at the taxpayer without us. Then it really helps, provide the evidence. Because one thing to understand, and I think you guys might know it better than I do, that many taxpayers think that taxes are deterministic. I mean, there's a law, there's a company, and that's the taxes that you pay, that's it. But actually, it's many times it's more than that. It's an interpretation, there's gray areas, and so, it's really a matter of you being able to tell the story correctly in front of the IRS. And I think we use the services of you guys when our insured are getting audited. So perhaps you might be able to share from your aspect, how does it help your clients when they are collecting their documentation in a proper way?
Very nice, Guy. Thank you so much. And so, before we transitioned into our into the next phase of our discussion, does anybody else have any last minute thoughts or quick insight before we transition to the next stage of our panel?
So, John, one question I think might be helping audience is, how do we help a client who is going through a 1031 exchange situation, and then at the same time considering the cost segregation as a strategy with the future acquisition? How does he kind of maneuver between these two things and analyze a future deal?
It's a good question. It's a fairly deep one, understanding both 1031 law and cost segregation law, or regulations, I should mean, not law. There's been an issue with when a 1031 is done, is separating out the personal property from the real estate and what's moving forward and what isn't. And the last hearing I had on it, I've not been involved in any of recent, but personally, but that there was a consideration of creating the basis coming in for cost segregation. We have to remove the money that's come forward, obviously, but also the valuation in the personal property that's been declared. And that then becomes the new basis. Well, you have to take out the value of land also, and then that becomes the new basis. And then that's what we deal from there. And I know that there's a lot of verbiage that goes with all that I'm not that much an expert on on 1031s. Very familiar with them. And I don't know if that laws or regulations are being looked at for change, but I think you'll get different answers from different people on how they're looking at personal property and what's in the contract and what's not in the contract, and how school boards look at it. School board will look at, no, they include everything, personal property, everything, because they want taxes, and they'll fight your tax. They'll fight you before the tax commissions in the state level to certify that it includes the personal property. So you've got federal and you've got state, and they can be looking at it two different ways. So it's definitely consult with counsel on that. So attorney that's well versed in it, because we can't make decisions in that as to what it is. We're going to take the CPA's certification or the attorney certification that this is what the basis is in all cases. So it's a legal something that I really can't make any sound statement on that this is the exact decision on how it's going to be. It's just been a little bit above my head.
Gotcha. Yeah. Our partner, Jillian, was supposed to be on the call today, the 1031 exchange partner. She got into some other meeting and could not join, but maybe in the next event, we'll bring her in. We can bring that perspective to the table.
Yeah. Yeah, I highly recommend, deal with professionals like Krishna, and help go through some of these processes. You don't want to use AI to tell you what's right.
Oh yeah, absolutely.
Even though it's free, you get what you pay for, maybe.
Right.
Thank you, John and Krishna. And now we are entering into the final approximate 10 minutes. It's 12 minutes till we put the bow on Tax Talk 2025. And so I am going to take the final 9 minutes of our webinar to continue this conversation. And we're going to dive into the world of wealth management. And especially if it's specifically tied towards high net worth individuals. And so this is going to be a round robin style question. So now my question is what tax strategies are the most effective for preserving generational wealth? So I will hand the mic off to anybody to kick it off.
So I will kick it off as a financial fiduciary and a financial planner. Yes. So basically, the wealth management is transferring the wealth tax-free for the next generation, right? It's not about making money. It also is being responsible to pass that money along to your beneficiaries and to your family tax-free as well. And that is where an irrevocable trust, a spousal lifetime access trust, and also a grantor trust, and all these trusts will basically help the grantors pay the income taxes and allow the trustees to grow uninterrupted of their assets as well. And also, like if you're in the state of Maryland, there are like around 12 states across the country where you have state estate taxes. And state estate taxes, even you just transferring over $1 million, you have estate taxes as well. And you need to make sure that there is not a fire sale happening in the family to pay the state estate taxes when you pass away. That is another very important aspect from wealth management and wealth transfer. And also the Roth-free accounts, since our national debt is ticking close to $37 trillion, it definitely makes sense to have some kind of tax-free wealth in your portfolio where you have guaranteed income coming into you and also guaranteed tax-free income coming into you as well, because taxes are a huge burden for every individual and every small business in the country today. And that is what I would like to express. If anybody has any of these tax-free strategies or do not have anything, all they're having is a 401k or a traditional IRA where they're going to pay taxes when RMD kicks in, or all of these are exposed to the stock market, there are different strategies where you can reduce the market risk, reduce your tax risk completely. And that is how I helped most of my clients make sure that they have enough during their golden years of their lifetime. Thank you, Sina.
Thank you, Abby. And I actually want to follow up with you because you made a mention regarding different types of ways they can minimize taxes, whether it's through leveraging trust, real estates, or charitable organizations. So how can high net worth individuals can leverage not only those key factors that I just mentioned, um, but other different types of financial assets
Yes.
that they have.
So the problem with the most of the high net worth individuals is right now you see what is happening in in the market volatility, right? Every day their financial assets are getting a huge hit. Any 401k or any retirement account in anybody's portfolio is basically down close to 10% to more than 20-30%. So what we can do is we can leverage guaranteed guaranteed rate of returns as high as 5.5% when the market is so volatile. And also you can defer the taxes for the future where you don't have to pay any taxes as well. So that guarantees gives you the enough income that you need for the future, reducing your stock market risk and reducing the tax risk. That is one. The other thing is setting up these trusts, right? The setting up these trusts, there is nobody coming in, no creditors are coming in and trying to take out your money, right? You're putting everything in a trust where to set up a trust for a basic trust, it only costs like $300. And only when you need to set up an estate or a preservation trust is where it takes you, close to $2,000, $3,000 with an attorney as well. So I have an estate attorney as part of my team who can come and help us and segregate as these trusts as well. So high net worth individuals, they have actually climbed the mountain, right? And now they are just staring from the mountain what to do, right? So that is where you need to take out these risks and make sure all these risks are taken off the table and making sure you have enough for your future as well, and make sure you're passing it on to your beneficiaries as well as a wealth tree transfer. Yes, hope that helped you.
Thank you, Abby. Guy, can you give us like a quick minute or 90-second answer regarding the role of insurance when it comes to sophisticated tax planning?
Sure. Sophisticated tax planning, although they could be very accurate, sometimes they do alert the scrutiny of the IRS. For example, cost segregation, R&D credits sometimes. You need to have someone like John that have never been challenged successfully, if I'm not mistaken. You mentioned that at the beginning, right? And so these type of strategies, although they save you a lot of money and you should utilize them, in some cases, they do increase the risk of you being audited. In that case, we come into the picture because if you have done and used the services of professionals that know what they're doing, there's no reason that you would be challenged. And we come into the picture and say, we agree with you that there's no reason for you to be challenged. So if you challenge, we will provide for a fraction of the cost, we will provide you with the necessary protection to handle this challenge. So that's where we come into the picture.
Thank you, Guy. I really appreciate it. Well, fellow panelists, we have now reached the final 3 minutes of our Tax Talk webinar. Attendees that are interested in learning more about their own tax strategy and many other different financial related questions, please fill out our free discovery call form where one of our fantastic experts will set up a time with you to go in depth on a one-on-one regarding everything surrounding your financial ecosystem. system. And so we are now heading into our final 2 minutes of our webinar. And so I am going to give the floor off to anybody among our panelists who wants to offer their final thoughts, any other questions or suggestions that you may have. So so if anybody wants to chime in, feel free to do so, and then I will wrap up.
I'll throw in, thank you for the opportunity to be here. Some smart people in this room here offering some really good information to everybody, and I was honored to be a part of it. So thank you.
Thank you, John. And so anybody else from our fellow panelists who would like to offer any final points?
I'd like to thank everybody on the call, and all the panelists who contributed for this amazing call. I would also like to offer like free strategy session for anybody who needs additional help, want to go over their personal situation, or need any kind of advice. You could fill the same link that Yesenia offered here, set up a discovery call. We will spend quality time and really dig deep into your situation, and then figure out a strategy to help you. We have a few other experts in our team could not join in this call. No matter what your situation is, like I mentioned before, anything related to asset and liability protection, tax, wealth preservation, and growth areas, we will be definitely able to help. Once again, thank you for everybody. And Yesenia, thanks a lot for organizing this.
Thank you, Krishna. And so now we've reached the 3:00 mark. Thank you, fellow panelists, Abhi, Krishna, Guy, John, Shai. Thank you all for taking your time to speak with our audience surrounding Tax Talk 25, strategies, tech, and smarter planning for the road ahead. Quick final notes. Don't forget, we have our free discovery call. Our form is on the chat. Feel free to fill it out and reach out to one of our fellow tax advisors. Obviously, Krishna just mentioned he will also be offering a free strategy session. Don't forget to follow us on social media at LinkedIn, and as well as our official website, www.geniustaxadvisory.com, where you will get all of the latest surrounding our services and all of the latest information surrounding Genius Tax Advisory. And don't forget, this attendees will be receiving an email following this webinar with a post-event survey, the recording, and as well as the free discovery call form. And so we are all very much looking forward to seeing you again on the Zoom universe for our next virtual webinar. So please keep tabs and follow us again on our communications mediums. So and finally, this webinar will also be made available across primary communications mediums as well. So thank you all so very much for joining, fellow panelists. To our audience, thank you for such a timely, relevant, and an outstanding conversation. And I will see you all next time in the Zoom world. So take care, everyone. Happy Thursday.
Bye, everyone.